It's Brian Preston, the money guy.
All right, Ron has a question. He says, wife has $300K in student loans at 7% for a doctorate program, but these will be forgiven in 6 years with her current employer. Should we treat it as high interest debt and pay more than the minimum, or should we treat it as high interest debt and pay more than the minimum and then slow down investing? What do you think?
All right, so Ron, I'll give you the disclaimer first. It's really difficult to give we can't give specific, unique financial advice to you because we don't know all the other circumstances. We don't know what's going on in your and your wife's situation. But we can speak to are some things to think about. Now, Reby, I'm going to recap this to make sure I've got the facts correct. His wife has $300,000 of student loans at 7% with her current employer. She's on pace for them to be forgiven in 6 years.
Yes.
All right, so the debt will be forgiven. And so the question is, do I pay on it aggressively or do I pay the minimum in order to have the most amount forgiven, right?
Right.
Did Ron give us any scope of their age?
He did not.
All right, so I'm going to go on a leap here. I'm going to assume medical school took a while to get through, accumulate that much. We're going to say they're probably in their, mid-30s? Somewhere in that ballpark?
Early to mid-30s.
So for someone in their early to mid-30s, Brian, approaching this kind of thing, right? $300,000 in debt, there's this thing that could happen. What are your thoughts? I mean, I've got some thoughts, but what are your thoughts on how you would approach that?
This is where we have even though we have an age difference, we probably share a brain.
Yeah,
because
for sure.
You and I have large sums of money that we owe to institutions together, and we have lots of debates about it. Here's what I think you would say, and I kind of agree with this, is that you've got a unique thing. Look, $300,000 of student loan debt, holy cow.
It's a lot.
That is, can you imagine trying to eat that elephant? I mean, that just seems overwhelming. Now, you first of all, hopefully, because you've heard our guidance. Now, it's always different for professionals, because you said it's a doctorate program. I don't like people to have more student loan debt than what they can make the first year in the job. So that just $300,000 is such a big number. But here's what I want you to think about this. You gave the information that in 6 years, this could be forgiven by the employer. I really hope they like their employer.
Yeah.
And I really hope they like that job, because that is a tremendous benefit. I mean, if you just take $300,000 and divide it by 6, I mean, you can see that is a substantial sum of compensation that would really make me lean hard on. Take that into account when you're figuring out, do I go take another job? Because that's worth a lot of money. So that's part of your handicap process of figuring out the decision making is, what is that worth and how realistic it is for your spouse to stay at that job for 6 years. The next thing you can do to protect yourself, to turn this into a math exercise, is that whatever you were going to pay on that, within reason, I want you because you're more than likely, you're not going to be able to fund the Roth IRA under a traditional way and other things. But I would like you to probably, over the next 6 years, be able to track what money got put elsewhere.
I love it.
So that you have an opportunity that if you don't get the forgiveness in 6 years, then it's a matter of the opportunity cost was just the interest carry cost that built up in the background while that money went and did some other purpose, and you would only be out that money. And I think if you compared what that cost of interest would be compared to what your money could do for you if you took advantage of the employer just wiping this debt out for you, that's the healthy alternative I would do.
But you've got to be so disciplined. Here's what you can't do. You can't say, okay, I'm going to do the minimum. I'm going to do the minimum payment because this is going to be forgiven. And then you allow your lifestyle to expand to spend those dollars on something else. I mean, if you can't build it up on the side, then you need to pay out on the debt. But if you're someone who can, just like Brian said, build up those assets on the side, just in case maybe something happens in the employer they don't forgive those loans, or a policy changes, or law changes,
you might get laid off.
You change jobs. Well, any of these things could happen. I think you have to have your fail-safe parachute in the background. Exactly what you said. But you have to make sure you stay disciplined to not pay the minimum with a plan that is going to be forgiven and not actually be squirreling away for the winter.
So I think there's probably going to end up being an after-tax account that gets heavily funded.
Yep.
Just in case this debt's not forgiven. And that way your opportunity cost is the interest carry cost, which is going to be substantial. But man, it could be a big windfall if all that debt is forgiven in the future. So I would come up with the best of both plans. Now, look, both said it. We don't like to give individualized advice because we don't know all your scenarios. We don't know your age necessarily. So this is just anecdotal information. That's something definitely, if you're at the state where you have good income, you have decisions that are this big, 6-figure decisions, man, that's something where hopefully you'll get to the point where you're taking it to the next level that you can make sure you really fine tune all the asterisks and details so your plan doesn't have the disclaimer we just gave. We just come up with the best course of action.